focus today's discussion on working capital management, meaning that's exactly what we're going to do. So, in case someone wants to join this meeting, I won't be able to tell. So, I believe we'll actually just end this session with you because right now I'm just looking at Excel. So, in case someone wants to join, I need to approve them, but I'm no longer looking at age or the meeting. I'm just looking at Excel right now.
Sasa kaangaleni huko. Go and pray huko.
Okay, so like I said, we'll look at working capital management. So that's what we are going to do. But firstly, I want us to understand what working capital is. What working capital is, because for us to be able to, for us to be in a position to be able to compute what working capital, we need to understand the theory as well. Let's say by definition what it is. So working capital refers to the capital used in the day-to-day operations of a business. Okay, so in summary, we can just say it's the day-to-day uh, operations capital or something like that. Okay, so it's the capital used for the day-to-day operations of the business. Okay,
Yeah.
what this actually represents is it represents the short-term assets and liabilities that a business needs to function efficiently. Okay,
Okay.
it
Yes.
represents the short-term assets and liabilities for a business to actually function efficiently and properly. Because every
Yeah.
single time when you're actually computing working capital, we compare two things. Okay, we compare two things, and the two things that we compare are current assets
Okay.
and current liabilities. We compare
Okay.
two things. That's the current assets, and we compare two things. That's the current assets and the current liabilities. Okay. So I'll just
Yes.
repeat the definition. It refers to the capital used in the day-to-day operations of a business, which also represents the short-term assets and liabilities that the business needs for it to function properly. So the
Yeah.
formula for working capital is the formula is like this: working capital is equals to current assets less current liabilities. This is what working capital is. Working capital is the difference between current assets and current liabilities. So basically doing a comparison between our total current assets and our total current liability. For instance, if our total current assets, our short-term assets, okay, our short-term assets are, let's say, 20,000 kwacha, and our current liabilities, which are actually our short-term liabilities, are
Yes.
maybe 15,000 kwacha. This means our working capital will be the difference between the current assets and the current liabilities. So we have 20,000
Yeah.
minus 15,000, giving us 5,000 kwacha,
Yes.
like this. This is how it's going to be. So working capital, 5,000 kwacha. Okay,
Okay.
this is how we compute working capital. Working capital is the difference between current assets and current liabilities. I'm basically doing a comparison to find out or to find uh, the value of our operational capital, which is our
Yeah.
working capital. Okay, so now that we are familiar with the formula, we understand the formula. We also need to make sure we understand these two things as well: what current assets are, what current liabilities are. Imagine this. Imagine you're in a situation whereby you have a question, a proper question, that's given you a balance sheet.
Yes.
Okay, giving you a balance sheet, or maybe it's not even a balance sheet, maybe it's a trial balance, or it's probably some weird looking list. Okay, and then they ask you to compute the working capital. You know, working capital is the difference between current assets and current liabilities, but you fail to identify the current assets and the current liabilities. Thus, you can't really come up with the totals for each,
Yeah.
making everything a bit difficulty for you. So
Yes.
we also need to make sure we understand the small components of our formula. We understand what working capital is. We need to make sure we understand what current assets are and what current liabilities are. Okay, so I'll
Yes.
give you an example of current assets. By current assets, we mean short-term assets. Okay, assets
Yes.
that will probably be used up in a short period of time, such as cash, accounts receivable or trade receivables, inventory that might be sold, or basically any other short-term investment. For instance,
Yes.
like prepayments. Okay, all
Yeah.
right. And then current liabilities, we are talking about things like accounts payable, bank overdrafts, or short-term loans, or basically accrued expenses. We are looking at all short-term liabilities,
Yes.
excluding the non-current liabilities, the long-term liabilities. So we get our short-term assets and our short-term liabilities, and we find the difference, and the difference is our working capital, our operational capital.
Yeah.
Okay, so that's the theory. That's what working capital is. But why do you think it's important for us to be in a position to manage to compute our working capital? Number one, we can say it actually shows us if we have enough liquid resources to cover our liabilities. Because here we are doing a comparison between our current assets and our current liabilities. Like in this case,
Ye-
we have the positive working capital, meaning we can cover all our liabilities.
Yes. Okay.
Yeah, yes, you get my point.
Yes, exactly. Okay.
Um, uh, so, so that's exactly the way it is. Um, so I was just checking something. Okay, all right. I was just checking something. Okay, so basically to show us if we have enough working capital and we can confirm it just like that. Okay, so that's one importance. So it ensures liquidity to pay short-term obligations. It also improves our operational efficiency because it will show us if we have enough funds to cover our operational expenses. And
Okay.
then it also helps us to avoid overinvestment or underinvestment in current assets. Okay, it will also help us to manage our cash flow and maintain credit worthiness. How do we maintain credit worthiness? We can either reduce our current liabilities if we notice that our current liabilities are higher than our current assets, or we
Okay.
can pay off our current liabilities on time to ensure that we have a very good working capital.
Okay.
Yes. So, like I said, this will be in brief. So I don't know if you are taking notes, because
Yes,
I'm not
yes, actually.
typing most of it.
Yes,
Okay.
no, actually, I'm taking notes.
Okay, so there are a number of things that we can consider to be features of working capital, or rather components of working capital. Those things are, for instance, we can talk about inventory. Okay, inventory. Inventory is a feature of working capital under the current assets. Okay, by
Ye-
inventory, we are talking about things like raw materials, work in progress, or finished goods needed to meet production or sales. We can also talk about things like receivables, which is the money
Yes,
owed by customers, or the trade debtors, which is also part of the current assets. We can also talk about the payables, which is the money owed to suppliers, or the trade creditors, the trade creditors. Or we can talk about cash, either in the bank or in hand, which is also part of our current assets. So basically, all the aspects of a current asset and a current liability are known as components or features of working capital. And they are very, very important when it comes to working capital management.
yes.
Okay. All right. So there are a number of things that I would actually like us to talk about. Number one, I also wanted us to talk about the types of working capital. Also talk about the working capital cycle. Uh, but but due to time, I'll just skip to ratio analysis.
Okay.
Yes. If we have time in the future, or you need to join the session, you can just let me know, and then we'll probably make some even more better time. Yeah. Okay. All right. So basically, this is what working capital is. Okay. This is what
Yes.
working capital is. This is just working capital in brief. Let me
Okay.
give you an example. Let's do this. Before I know I did an example, but let me just make another example, like example. Okay, so let's imagine we have a company ABC. We have a company ABC, and company ABC has the following. It has got cash. Let me just make all this kwacha. Okay, it has got cash. The cash is 5,000. Okay, and then it has got inventory. The inventory is 15,000, and then
Okay.
it has got trade receivables. It has got trade receivables of 10,000, and then let's say we bring in the trade payable as well. It has got trade payables of 7,000. Okay, and then we bring in an overdraft. It has got an overdraft facility that it utilized, and the overdraft is 3,000 kwacha. Okay, so we have cash.
Okay.
This is the information that our question has. Company ABC has cash
Yeah.
5,000 kwacha, has inventory 15,000 kwacha, has trade receivables 10,000 kwacha, had trade payables 7,000, and overdraft 3,000. Okay,
Yes.
so
Okay.
now the question is calculate calculate the working capital of company ABC. Calculate the working capital of company ABC. Let me just check if she's trying to do it. No one is trying. Okay. All right. Calculate the working capital of company ABC. So now this is our question. So how do
Yes.
we do?
Yeah. Okay. Based on the information that we have been given on the assets and the liabilities for company ABC, we will take into consideration first the current assets which we have. So we have got cash of 5,000.
Okay. So
Current,
current assets,
current
we have
assets we have
cash.
5,000. Yes. Then we have got inventory, which is current asset as well. We are adding that 15,000.
Okay.
Then we have got trade receivables of 10,000. We are adding that as well. It's the current asset.
Okay.
Then let's get our answer for those three. We can enter. So based on the information, we have got total assets amounting to total current assets amounting to 30,000. Then let's take now our current liability. So we have got trade receivables of 7,000.
Trade payables.
Then also we are trade payables, yes. Then we are adding that bank overdraft. It's a current liability as well. It has to be paid within a period of a year.
Okay.
So for current liabilities, we have got a 10,000. So following the working capital formula, we are now saying working capital is equal to uh, 30,000 that we have under current assets. Then we are lessing the current liabilities, which is a 10,000. Okay, that looks like
Okay. So yeah, this is how we compute our working capital.
okay, wonderful.
Yes, this is how we complete our working capital. Okay, so due to time, since we have about 27 minutes remaining, we'll go directly to ratio analysis. Hope you understood working capital.
Yeah, no, this one is clear now. I've understood. Unless if maybe a question comes in a way that is a bit more complicated, maybe we have information more than what we have looked at.
Okay.
Yeah.
That's the benefit of joining my sessions, sir. Because when you do, uh, the sessions will it will be more like this, but more time and more practical. It's more like we solve the question together. You solve the question, I explain it, I break it down, make it simpler. We solve, we practice. That's what we do.
Yes.
Okay, so let's go to ratio analysis. I also do it in brief. Okay, so ratio analysis is basically the process of interpreting or analyzing financial data. Okay, you are analyzing. That's where the word analysis is coming from. So it's the
Yes.
process of analyzing financial data. Let me just say, process of analyzing financial data, the process of analyzing financial data, or let me say analyzing and interpreting financial data
Yes.
using ratios. So ratio analysis is basically the process of analyzing or interpreting financial data using ratios. We're basically studying financial data. We look at financial information and then we try to interpret it. We try to explain it using ratios. That's what ratio analysis is. So when it comes to ratio analysis, we have two types of ratios. We have two types of ratios. Okay. Um, okay, we have types of ratios rather. So the first type is the liquidity ratios.
Yes.
So the first type is the liquidity ratios. Under the liquidity ratios, we actually find ratios that show us if our business has enough liquid resources. By the liquid resources, I'm talking about cash or cash equivalents, items that are either cash, which is money, or items that we can easily change to cash.
Yes.
Okay, examples of liquidity ratios, we'll find things like the current ratio. You've heard of the current ratio.
Yeah.
We'll find things like the current ratio, the quick ratio. So we have the current ratio and the quick ratio. So these two are actually the liquidity ratios. They show us how much, they'll show us if our business has got enough liquid resources. Okay?
Yes.
Okay. So let's start with the current ratio. The current ratio will tell us our ability to pay off short-term debts. So the current ratio, let me just say, okay, it tells us our ability to pay off short-term debts.
Okay.
Okay, so the formula for a current ratio, just give me a second. I just want to pull this. I'm pulling the right thing. I was pulling something different. Okay, let me pull this. Okay, and then the formula, so the formula is actually the current ratio, the current ratio is
Okay.
equals to current assets over current liabilities. Okay, it's equals to current assets over current liabilities.
Liabilities, yes.
Yes, so it shows us our business's ability to pay off our short-term debt. Okay, and then a quick ratio is more like a current ratio. It shows us our business's ability to pay off short-term debt, but it excludes inventory. It firstly
Okay.
takes out the inventory, and then afterwards it divides the value, the remaining amount, by the current liabilities. So the formula will be, by the way, the quick ratio is also known as an asset test. The formula will be quick ratio is equals to current assets minus inventory, we close, divided by current liabilities. Okay, this is what a quick ratio is. So the difference, there's only one particular difference between a current ratio and a quick ratio, which is excluding the inventory
Okay.
from the current assets. So the quick
Yeah.
ratio excludes the inventory from the current assets. And then, apart from the liquidity ratios, we also have efficiency ratios.
Okay.
Okay, we also have efficiency ratios. So efficiency ratios basically show us how, this is me typing things I'm not supposed to. Efficiency ratios like this. Bold. Okay. This is me again. I don't know what's happening.
Mhm.
Okay, so efficiency ratios, they basically show us how we utilize our resources, maybe human resource, or how we use our machinery, or basically anything. Okay, but it's looking at the
Yeah.
usage. Okay,
You
that's
said yes.
efficiency, yeah, or the activity ratios. So examples of these particular ratios, we can find inventory turnover. We can find receivables turnover ratio.
Okay.
So yeah, we can find receivables turnover ratio, and we can also find the payables turnover ratio.
Okay.
And then we can also find the working capital cycle. Okay, these were supposed to come here. Okay, so inventory turnover ratio, which is the first efficiency ratio, it basically indicates how fast inventory is sold, how fast we sell our stock. So this one indicates how fast we sell our stock. Okay, and then what is the formula? So the formula for inventory turnover,
Okay.
yeah, for the formula for inventory turnover, which is inventory turnover ratio, is inventory turnover is equals to we get our cost of sales. Okay, we get our cost of sales and we divide by the average inventory. This is the formula for inventory turnover. It's cost of sales, and then we divide by average inventory. So it shows us how fast our inventory is sold, or how fast our inventory is
Okay.
changed into cash. Okay, then we have a receivables turnover ratio. We have a receivables turnover ratio. A receivables turnover ratio basically shows us how okay, let me put it like this. It basically shows us how much of our receivables is actually turned into cash. Okay, so we'll get our uh, let's see, shows us. Or let me just change the wording. Let me say how fast our credit sales tend to cash. What I
Okay.
mean is how fast the credit sale, how fast our credit customers pay for the money, pay for
Yes,
the
yes.
goods. Okay, so the formula is receivables turnover ratio. Okay, the formula is receivables turnover ratio is equals to receivables turnover ratio is equals to we'll get our credit sales,
Okay.
get our credit sales, and then we divide our credit sales by the average trade receivables amount. Okay, so get our credit sales and then we divide by the average trade receivables amount. And then we have our payables turnover ratio. This is basically how fast we pay our debts,
Yeah.
our short-term debts. Okay, how fast we pay our short-term debts. So the formula will be payables is equals to the payables turnover ratio. Just write it in full. Payables turnover ratio is equals to our credit purchases divided by our credit purchases divided by the the average payables.
Yeah.
Okay, and then the last one, which is the working capital cycle. Okay, which is the working capital cycle. What it does is that it actually does a comparison. Okay,
Okay.
basically it's a total. How can I put it? Working capital cycle represents the total. Okay, it's more like a total period. You see the way we have our receivables, our inventory number of days, and our payables. By the way, all these ratios we have to
Yeah.
multiply them by the number of days, 365. Okay.
Oh, yeah.
Yeah,
365. Yeah. Yeah.
yeah. Okay.
Okay.
And then same way we have all these days. Working capital cycle is basically a combination of all these three. Okay.
Okay.
Working
This.
capital. Let me put the formula first before I put the explanation. So working capital cycle. Working capital cycle. Working capital cycle will be, we will have our inventory days, of
Okay.
which we get from calculating the inventory turnover ratio. And then we get our
Yes. Yes.
inventory days, we add our receivables days for our assets,
Okay.
Then afterwards, we subtract our payables days. We basically the working
Payables.
capital formula, which is assets minus liabilities, but this is in form of days. The total assets days and the total liability days.
Okay.
Yes. So basically, we are trying to find out the total number of days we can have extra after we've paid all our debts, our short-term debts, because we are comparing our assets dates, and then that's our inventory days plus our receivables days, and then we remove the payables days.
Yes.
Okay, so those are the efficiency ratios. Okay, so we actually have a number of other ratios. We still have profitability ratios, and the other one is like it's gearing ratios. Okay, we have profitability ratios and we have gearing ratios as well. So we just finish up on the profitability. Okay, so the profitability ratios, since it's actually self-explanatory, basically these are ratios that show us the profit. Okay, it shows us, yeah, it shows us the profit of the business. So examples of profitability ratios, we can talk about things like the gross profit margin. We can talk about things like the net capital margin, the net profit margin rather.
Okay.
Okay, and we can also talk about things like the return on capital employed, ROS.
Okay.
Or let me just type it in full. Okay, the return on capital employed. Okay, so let's start with the gross. Yeah, let's start with the gross profit margin. Okay, so the gross profit margin is basically a comparison of our sales and gross profit. Okay, we're basically trying to find out. Okay, I want to find the perfect explanation for this one. You've written all the other ones?
Yes, yes, I have.
Okay, I'm looking for the
Gross profit.
perfect words for this one. I think what I wanted to say. Okay, so I think the perfect definition can be, let's say the gross profit margin, we can define it as, let's say, a percentage of revenue that basically
Okay.
exceeds the cost of goods sold. A comparison between our revenue and our cost of goods sold. Okay.
Okay. Cost of goods.
Yeah. Yeah. So we can say percentage of revenue and a percentage of revenue that exceeds the cost of goods sold.
Okay.
Okay. So the formula for the gross profit margin. Okay, let's do this. Since I've explained what the gross profit margin, a percentage of revenue that exceeds the cost of goods sold. What do you think net profit
So
margin?
yes. Let's see. Let me see. Since I hope I'm right. Since on the gross profit margin, we are looking at the gross profit. Does it mean on the net profit will take as the percentage of revenue that exceeds the net profit?
Yes.
Is it?
Yeah. Wait, wait. Oh, okay. We can say the percentage of revenue that exceeds all operating expenses.
Okay.
Yeah, the percentage of revenue that exceeds all operating expenses. We can put that as a definition. So
Yes.
yeah, we've already given. So we said the percentage on the net profit margin. We said the percentage of the percentage of on the gross profit margin. We said the percentage of revenue that exceeds.
The cost of goods sold.
Yes. Yeah. So the
Okay.
percentage of revenue that exceeds the percentage of how can I put it? The percentage of revenue that exceeds the cost of goods sold, and then the other one is the percentage of revenue that exceeds all operating expenses. So the formula for the gross profit margin, is we get our gross profit and we divide it by our sales. Then we multiply everything by 100%.
Okay.
Yes. Then here, the net profit margin, we get our net profit divided by our sales multiplied by 100%, like this. And then we have the return on capital employed, self-explanatory. It measures the return on the business's capital. Like it measures return from the total funds you invested in the business.
Yes.
It
Yes.
shows you
Okay.
how much you've gained on your capital. That's the return
Right.
on capital employed. So this is also known as ROS. That's just an abbreviation for it. So the formula for ROS is we'll get our operating profit. Okay, we'll get our operating profit divided by the capital employed times 100. So we'll have our operating profit sorry, let me just check if someone was trying to join. She just sent me a message asking if I'm recording. Oh, yeah. Hello. Hello. Hello, good afternoon. Hello, good afternoon. Madam Messi, good afternoon. Hello? Okay. So we are currently looking at the return on capital employed. We say it measures the
Yeah.
return from total funds that you actually invest in your business. Okay. So the formula for this particular ratio is we get our operating profit. Okay. We get our operating profit. Then we divide it by the capital employed. I have to show you how to find the capital employed as well. And then we multiply everything by 100. Yeah, to be the operating profit divided by the capital employed multiplied by 100%. That's the formula for the return on capital employed. Madam Messi, how are you? Okay, so we are actually looking at ratios. We've looked at liquidity ratios. We started from working capital. The formula of working capital. We even solved an example. And then after we finished, we went to ratios and we looked at liquidity ratios, efficiency ratios, and also profitability ratios. Okay, so these are the
Yes.
main ones that we have looked at. We are only remaining with a number of other ratios like the gearing ratios, for instance, the debt to equity ratio, the interest cover ratio. Yeah,
Gearing
so that,
ratios, is it?
sorry. Yes, gearing ratios. We're only remaining with the gearing ratios so as to finish up all the ratios. So for you to finish up all the ratios, you need to understand the liquidity ratios, efficiency ratios, and the profitability ratios. And Madam Messi, yes, this session
Yeah.
was being recorded. Okay, it was being recorded, so um, you can actually watch it anytime as soon as I upload it. Okay, but our session was starting at 14 hours up to 15 hours, and we've hit 15:02. Okay, unfortunately, we'll be ending right here. If you'd like me to send this spreadsheet, I can, but we'll be ending right here. Okay.
Okay. Sure.